Hi, this is Anthony Parent of Parent Parent LLP, the IRSMedic, and welcome to our 2014 Guide to Offshore Voluntary Disclosure. And this is part one, where we'll be discussing what is OVDI, what is OVDP, and what is the big deal. So if you have unreported foreign accounts, this is the right place, and I hope you enjoy this video. Now, just a little bit about us. We are Parent Parent LLP. We are a tax firm. We are based in Connecticut. We are made of tax resolution attorneys. And I've been told, I have not confirmed this, that we have the biggest offshore caseload of clients going through the OVDI process. We've been involved in this since 2009, and we have learned some things along the way, and every day we learn a little bit more. And I'm here to share some of what we've learned with you. So what we're going to do is we're going to answer a few of the offshore FAQs, the frequently asked questions, number 1 through 6. And you would find this at the IRS FAQs, the OVDI section. And these are sort of the settled law of the land, if you would, on OVDI. It's a very new area of law and will be expanding in the coming years and is not going away. So our first question is, what is IRS OVDI? Well, it stands for Offshore Voluntary Disclosure Initiative. Now, some of you may have heard of the OVDP. And what the heck is that? Well, that stands for IRS Voluntary Disclosure Program. And it all started off, the IRS used to call this OVDI, but then they changed it to OVDP. But then sometimes you'll see it referred to as OVDI. So why the change? And I guess, the only thing is I can imagine there's some clicks at the IRS. Right now, OVDP seems to be winning out. But then again, the OVDI people, they sort of will put on they will try to sneak in their arguments every there. So there's really no difference. We use the terms interchangeably, and so can you. Well, first, before we talk about OVDI or OVDP, whichever your preference is, I want to talk a little bit about what voluntary disclosure is. So let's remove the offshore component to that. Just a voluntary disclosure, straight old IRS voluntary disclosure, what things used to be before 2009. And these are the facts. The IRS has limited resources to prosecute people who evade taxes. Trust me on this. The IRS is well aware of many, many people who are evading taxes, but for various reasons decide not to prosecute. Then on the other hand, there are many people who have evaded taxes over the years, but now they realize that the emotional turmoil, that even though they haven't gotten caught, they don't feel like they're getting away with anything because they know that at any point, the IRS loves to be dramatic, that the IRS could barge in their door at midnight or track them down at their golf course and come in with their gold badges and make a big stink of things. And so that's where the tax evasion is more costly than they first imagined. So it used to be that somebody in such a situation would contact an attorney. The attorney would contact IRS Criminal Investigations and say, hey, I have this guy. He's looking to come clean. Would you not prosecute him if he came clean? What's our agreement of what this taxpayer will pay? And it was an informal process, and there really weren't too many of those voluntary disclosures happening each year. And it was a win for the IRS because they got a lot of compliance, and then it was a win for a taxpayer because they got their sleep at night. And that's what it used to be. Voluntary disclosure was once the exclusive domain of people who had true criminal exposure. So the IRS said, after there was a whole scandal of UBS that started in 2004, why don't we extend this to offshore tax evaders? And it made sense. The IRS assumed the vast majority of people with offshore accounts were intentionally evading taxes. And I can tell you this is just not true. This is not true in any sort of way. And the IRS admits it. Well, some of the IRS will admit it, not everybody. 95% of the people who IRS, maybe even 96, are innocent. They made innocent mistakes. They didn't know that they had to report their worldwide income. What the IRS doesn't realize, but what everybody else does, is the IRS taxes U.S. persons. Okay, you just don't need to be a citizen, just a U.S. person. So that could be a green card holder or a visa holder on their worldwide income. And no other country does what the United States does. So you have a lot of dual citizens, visa holders, expats who weren't quite aware that their worldwide income is subject to taxation by the IRS, even if local taxes are paid in that foreign country. So the IRS vastly overestimated how many people were intentionally evading taxes, but underestimated people who were making innocent mistakes. But still, here we have these FBAR penalties that the IRS can assess and makes a presumption of. And so that's the whole idea, that with this offshore program, there's these FBAR penalties looming about and other penalties that simply don't exist in the case of a domestic voluntary disclosure. So this is what I want you to understand. It is much better to have intentionally evaded taxes domestically than have unreported foreign income from unreported foreign accounts, because fines for domestic voluntary disclosure are based on the amount of tax unpaid, originally unpaid, unreported. But fines for OVDI, or OVDP, are based on an amount of tax are based on an amount of tax unpaid and account and asset values. That's a huge difference. But see, the IRS invested a lot into this OVDI program. If someone was cynical, someone would say, a lot of careers in Washington count on the OVDI program proceeding, so we'll proceed. Some person cynical might say, it is theater. It is theater to make it look as if the IRS is cracking down. But in fact, they're making a big stink on a whole bunch of people that won't really increase or decrease the tax gap all that much. And just in a little aside, that last year the IRS had a big press release where it bragged about the $4.5 billion the 2009 and 2011 programs brought in. But what they didn't talk about is the $4.5 billion they lost by simply by paying too much people, by giving people credits that they didn't deserve. And it was a simple little thing too. It's just one of these things where the IRS can give this appearance of being being harsh, of looking like it's being harsh and on top of things, when in fact the rest of the IRS really isn't. Because if there was any fairness, this OVDP, for this 96% of our clients would be easy, low cost, and quick, who made innocent mistakes. And I'm going to tell you, it's none of those things. Now, if you have evaded taxes intentionally, it's a great deal. You should take it. I mean, it is a great deal. If you have been intentionally evading taxes, go through the program. You absolutely should get it done. And it's a great way to get your money overseas that might be blocked. It's a great way just to clear it up. So it is a terrific deal for those who engaged in intentional evasion. But again, as I said, most people haven't been. And it's a very unfair deal. The thing is taxes are usually tertiary to the penalties. The taxes and there's penalties related to the taxes. That's usually not the big deal. Because again, these are a lot of foreign accounts. And over the years, these bank accounts haven't really earned a tremendous amount of income. So there's not a lot of people we see where the tax bill is the sticking point. It's really the rest of the penalties, and people are looking for assurance on what their penalties will be. The other thing is attorney fees can be high. Trust me, they can be. And again, there's a lot of accounting work going on. Someone's going to go through the whole program. We have 8 years to amend, and it's just not filing an amended return. We know the IRS is going to scrutinize those. So just think what an attorney, accountant would charge for an audit, and then multiply that by 8 years, and then add in some penalty abatement too. And so you can get an idea that the cost can be quite high, and it is unfair. And worse, there are a lot of unqualified people out there who are claiming to be experts. It's one of the reasons why we created this video. We're taking over a lot of cases from people who hired other people who simply didn't know what they were doing, and they were even too lazy to look at the information I put on our blog that would quickly get them steered in the right direction, so that we know what other people are telling. And there's a lot of dangerous advice, and there's a lot of incompetent representation going by. And we found that it doesn't matter if it's someone low cost or high cost. The incompetency knows no boundaries. Now, so let's answer our first FAQ. Why did the IRS, and this is right from the FAQ on their website, why did the IRS announce a new offshore program? Well, the answers are they didn't get everyone. They know there's a lot of people outstanding and out there. And in fact, they have a pretty good idea that a lot of the people who are intentionally evading taxes haven't come forward, and they're rolling the dice. The 2011 program expired, and the 2009 program treated taxpayers all the same. That is, it didn't matter whether you made a mistake or you were doing it intentionally. There was one standard penalty for everybody. 2012 is the ongoing rules, and that's what we're talking about today. Even though it's 2014, we go by the 2012 initiative. FAQ number 2, what is the objective of this program? Now, if you were cynical, you could say to terrorize people. You also could say to collect revenue ineffectively, or to protect careers, or if you were the IRS, you would say to bring taxpayers into compliance. Here's FAQ, OVDI FAQ number 3. How does this differ from the standard VD, Voluntary Disclosure, the 2009 OVDP, and the 2011 OVDI? You see that? You see how they're subtly mentioning the P and the I? They never mentioned it. But in 2009, they never called it OVDP. It was OVDI. And so they're trying to make it look like they always called it that. They didn't. Just an aside. So as we talked about before, the standard VD has no penalties based on account value. And the 2009 treated all the same at 20% of account value. And then the 2011 came around, which was very different than the other ones because it increased the standard penalty to 25%, but it gave an opt-out where you could argue for a 0% penalty. 2012 also added a 12.5% penalty for accounts below $75,000 and added 5% in limited cases. Okay, but there are big limitations, and we'll be talking about where those go. But again, the 5% actually might be too high if you opt out, because you could ask for no penalties at all. With the opt-out, you can argue for no penalties, and that is a process, or non-willful penalties, and those are $10,000 per year. So the 2012 is a lot like 2011. But the standard penalty went up from 25 to 27.5%. My guess is this will be around for a while. The 2012 rules will be around for a while because the IRS has a huge amount. I think now they understand how many more people are going to be coming forward, and that the fact that so many people were making innocent mistakes. So FAQ number 4: why should I make a voluntary disclosure? So this is the criminal exposure. You know, if you don't make this voluntary disclosure, you're going to go to jail. And I'm going to tell you this: it's not true, not likely. The IRS has very, very limited resources to prosecute people. So for the 95%, that 96% of our clients, there's really not much of a case that is a true threat. The true threat is the fines. The IRS has this powerful law, the Bank Secrecy Act of 1970. Now, it's supposed to be used against terrorists and money launderers and drug traffickers, but they are able to use it as a stick, as a bat, to force people to go into the OVDI. Now, going a little bit out of order here because this sort of follows. FAQ number 6, what are potential criminal charges? Well, now one of the things going on, we're going to be talking a lot more about this. If you didn't file FBAR and you committed tax evasion and then made something called what people call a soft disclosure, or I even heard this, a qualified soft disclosure. Sounds impressive, but it doesn't exist. That the IRS can still come back and hit you with all the penalties that they want. But at least on the criminal angle, okay, it's not an easy case for IRS criminal investigation, CID, criminal investigation division. It's just not an easy case. But again, remember what I said? Your risk really for most people is not criminal. The bigger risk is the fear of being arrested. That might keep you up at night. But for most people, it's the fines. And if you do a soft disclosure, you really don't do a lot to undo the fines. And actually, you might be hurting yourself. That'll be something we'll talk about more. So I just start with that because that's what that's one of the natural inclinations people have, is said, this program's so horrible, there has to be an alternative to it. And then people will tell them what they want to hear. Oh, yes, there's this thing. There's this soft disclosure, quiet disclosure, qualified quiet disclosure. This will solve all your problems. And the thing is it really doesn't do anything. The IRS tells people not to do it, and they said they're going to penalize people hard, and there's actually some cases in which they have. Now, let's say you just don't do anything. Let's say that you don't file your tax returns, you don't file FBARs. The easiest cases for the IRS are where there are unfiled FBARs and unreported income, and anybody telling them that leads to the fact that you knew about this and that you knew the law and you didn't do anything. Okay, those are just slam dunks for them. And what happens is the IRS will charge people, and you'll see these in the press releases, because this is the deal that they'll say, okay, you can go to trial and you can lose everything. I mean, everything, you're going to go away for 5 years, and then the penalties we assess. And when you're away for 5 years, you might not have all the money to defend yourself legally. So we're going to assess all these penalties that will wipe out your entire value, because FBAR penalties, and we'll be talking a lot more about this, can be twice your entire net worth. And we're going to show you how in upcoming videos. So you can go to trial, lose everything, or take a plea bargain, do 3 years, and pay the IRS half. And how many people take that deal? A lot. Would you take that deal? Would you rather gamble everything? And you still know you're going to owe money, by the way. You still know there's going to be some penalties. But gamble everything to stay out of jail? Or would you just say, you know what, I'm going to go do 2 years, I'm going to go 2.5 years just so I can keep half of my money? And the other nasty thing the IRS does, the Department of Justice more specifically, is they charge spouses. They're going to do that. They're going to put that kind of pressure on you. Can you imagine, right? Your spouse being charged with a crime like this, who may or may not have known about it. I mean, that's really going to put a ton of strain. And that's why the IRS loves these, because they get these easy pleas, and they get their press release, and they get a ton of money. But again, those are for the cases where there has been intentional evasion. But again, I can't say just because you haven't, it's a guarantee. And there was a recent case in Florida where, boy, the facts in that didn't look like a spouse inherited a whole bunch of money overseas from a husband who might have looked like he was intentionally evading taxes, but she inherited a whole bunch of accounts overseas from him, and she didn't report him or report the income. And maybe that was an innocent mistake, but I'll tell you what, she paid $24 million in fines, and she pled guilty. Luckily, the judge in that case, and she was facing 3 years. She was 72 or 82. Luckily, the judge in that case sentenced her to 0 jail time and found it quite offensive that the IRS Department of Justice was being that aggressive. So as I say, most people, you're not a real target. That's not to say there's no risk. Some people will definitely be charged who have made innocent mistakes. I can tell you that. Now, let's just say that the IRS does have a hard case. This is what you need to think about. And this is why people take these pleas. See, if the IRS loses a tax case, what's the worst case for them, right? Prosecutor, ego is hurt. And And they'll always find someone to blame, but their career isn't really going to suffer all that much. Maybe they'll even help them. Say, hey, I'm not afraid of taking tough cases. They're not going to lose one dime. Maybe they'll lose a little sleep, a little anxiety. But if you lose, right, you lose everything. And one of the things is if you do get charged criminally and say you eventually win, let's think about how this is actually going to work. I work with actual criminal tax defense attorneys, people who actually go to trial and actually win. Okay, if you want to know what they charge, because they have a very full dance card. Okay, there's a big demand for these guys who can actually win. They're going to charge $350,000 to $1 million, and there might even be additional costs on there. And I'm absolutely serious. And so while the attorney fees for getting someone to the program are high, they're going to be a fraction of this. They are. And it's also something to think about when you're considering what you should do. What's the real cost? Are you getting any value for going through the system? Well, here's something to think about. Right? Even if you win, even if you beat the IRS, is it really a win if you had to go through the whole criminal process and pay this attorney $350,000 to $1 million? And just a little warning on this, and this is something I found out recently. Just because somebody has a blog about tax defense does not mean they actually go to court. So if you are looking for a tax defense attorney, you can contact us and we can refer you to someone who actually does go to trial. So many people. I mean, this is just something that's out there. They sort of know that there's there's a lot of fees to earn in this field, and they don't have the chops to do it, but they're skillful enough that they're marketing to make you think that they are. So another nice little minefield here, huh? Isn't this wonderful? Again, remember what I said? Your real risk is the horrific fines, and this is where we're talking about FAQ. FAQ number 5. What are some of the fines if you don't use the program? It's going to take years for the IRS to work through all those cases who they suspect about having undisclosed bank accounts, and also the people who've made their their qualified soft disclosure. They're working through those cases just to go through and penalize those people. I know we're going to get a lot of those people in the coming months and the coming years, people who did make the mistake of doing that. Upcoming too is there's a ton of information sharing with the foreign countries. And we also know that some of our clients who have if there's an American address on a signatory on a foreign account, a lot of places are just shutting these down, or they're just seizing a portion of the money, and so it's difficult. And so it's just so much better, if you're not to worry about something. It's really the fines are the best risk. I know I did talk about the criminal aspect a lot, but really, the criminal aspect will be something for a few. But the fines are going to be aspect for the many. Now the FBAR is the most well-known, even though still you might be learning about it today, and you might be saying no way. Well, no, it's there. The FBAR, if you don't file one, the IRS can assess you a fine of $50,000, 50% of the account value per year, and that's one of the informational returns. There's other ones. But the IRS, and this is something that I've been told, is the IRS now thinks that most of the intentional evasion is through the use of shells, where people don't have the account in their own name, that they used a foreign corporation, a foreign trust to hide the money, that they took those steps. And so there's penalties for failing to file those returns as well, if you are caught. And I think one of the things is if you did use a foreign shell, I mean, this is really something you have to think about. See, that's where you might be looking at that criminal exposure. Because think about how much easier you made the case for the IRS prosecutor. You can't really say you made it innocent. If hey, the account's in your name, I didn't report it. I didn't know it was a law. Okay, that's kind of plausible, and a jury would understand that. But in the case of a corporate shell, okay, that's not easy to set up. they're going to say, well, why'd you do that? Because we see it's just a shell. It's not a real company. You really didn't run stuff through it. So can you tell us the reason why? The reason why you opened this up under not your name, but rather this? There's a reason why. What was the business reason? Oh, there is no business reason. So what's the other reason? And there's a situation where it's probably best to plead the Fifth Amendment and not answer it if you were engaged in intentional evasion. So the other types of FBARs, these aren't FBARs, but I'm just trying to say these are the other types of forms out there where the penalties are not based on the tax unreported, but rather on something else. So the penalties could get very high, and we have a few different forms. Form 926, that's for transfers of property to a foreign corporation. Form 5471, interest in foreign corporations. That's if you're a shareholder in a foreign corporation or have some sort of interest. Form 5472, that's if you have a U.S.-owned corporation overseas. Form 3250, gift report. Form 3250, that's your trust report. Form 8938, which is now actually on your tax return, and it started in 2011. And there's a reason why. We explained that in our FBAR segment. And right now, actually at our website, we do have an FBAR webinar that's on replay. So if you, until we get our guide updated, you can go there to www.irsmedic.com. It's pretty easy to find. It's fairly prominent, our FBAR penalty guide. And then there's Form 8865 for those with partnerships. So let's be honest about this. The OVDP, look at that. I just switched to OVDP. The OVDP process is expensive, time-consuming, can be frustrating. But here's the one thing it does have. It gives a certainty of result. You never have to worry about this blowing up in your face or something your family will ever have to deal with. Now, here's the thing. I want you to subscribe to this channel. Why? Because part 2 of our 2014 OVDP guide, the OVDP process, is coming soon. Subscribe and you will be the first to know. Are you looking to talk to someone right now about making a disclosure? Well, then call our OVDP hotline right now, 888-477-4258, or email info@irsmedic.com. Regardless of whether you hire us or not, any communications you make to us are protected by the attorney-client privilege. This is Anthony Parent of Parent Parent LLP, and I thank you for watching.